So here we are, the end of quarter three, 2023, when we're recording this episode. And the real estate market is different. Let's not get it wrong. It's different. It's changed. It's moving. It's volatile. What does that mean? Well, we are seeing three challenges, three easy to see, very apparent challenges. Cost of money increasing, volatile, moving. It's hard to hit that moving target. The insurance costs are rising. So many insurance companies are dropping out, and taxes are increasing. So these three things paired together are across the board decreasing opportunities for investors like you and myself. But we have the answer. We have the solution. Real estate is the business of relationships. We can leverage these relationships, expand our associations with those who share our values, who share our character, who share our integrity, in order to increase our opportunities. Today's guest is going to walk us through his medical journey and his investing journey to do just that. He's a pulmonary and critical care physician, the CEO and founder of Dr. Breathe Easy Capital. He now is focused on increasing financial literacy among physicians and helping others achieve financial independence through real estate investing, through real asset investing. So there's more than just real estate to this. Please welcome Dr. Bayo Fasanya. Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable, real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. All right, Bayo, welcome to the show, sir. How are you doing today?
I'm doing great. I'm very excited to be here.
That's awesome. I'm excited to jump into I always love when I have guests on. Real estate is like my world, and I love having guests on that have that depth of experience in real estate. And today you have that, sir, and I'm excited to talk to you about that. But first of all, where are you coming to us from? Where are you at? Where are you located?
I live in Fort Smith, Arkansas.
Oh, Arkansas.
In the South.
Yeah. Oh, yeah. The South. It's a deep South over there too. So I actually, for a little over a year, I renovated Walmart, and we would go basically from Walmart to Walmart in the Arklatex area, Arkansas, Louisiana, and Texas. And there, the old homeland of Walmart is
Arkansas. Yes,
yeah.
The headquarters is here, and that's what is actually pushing the growth in this area. So like the universities, everything all centered around Walmart, and people wanted to work with Walmart.
Yep, absolutely.
It's insane what they built.
Yeah. Massive. And the generational billionaires, the old Sam Walton world has created. Very, very interesting. So in Arkansas, and I love also to share with the listeners a little bit of your medical journey, because you are a physician. And now an investor, helping other physicians make that change in their life. So tell us a little bit about your medical history, journey, and where you're at now.
Yeah, I mean, it's been a long road, right? So I'm a pulmonary critical care physician, but my whole education, right? I'm from Nigeria. So when I was in Nigeria, I started with veterinary medicine. Right. I was like 3 years into the program, and I was fortunate enough to be sponsored by my mom, who she, lived in Canada. So, and I moved to Canada, and I have to start all over again. Right. I went to University of Toronto, and then, I kind of met the pre-med people, they're very convincing, right?
Yeah.
At first, I was going to just go back to vet, but after kind of looking at the landscape, looking at how much I can affect, people's lives and things like that, eventually I made that decision. So because of the way the medical school work in Canada, there's only very few of them. And also the process takes about almost 2 years, right? to even get into the program. So I decided to apply for the medical school in the Caribbean. So I actually went to medical school at Sabre University, and that is in the Netherlands Antilles. So it's called Netherlands Antilles, but it's part of the Caribbean, Dutch Caribbean. So, did 2 years there. Then, usually you pass your USMLE step 1, then you come to which is the exam, one of our exams, right? Then you come to the US to do your clinicals. So I did my clinicals in multiple states, which actually helped me improve my cultural awareness and everything. So I did peds in Miami. I did most of my internal medicine surgery in Kansas City, Missouri. So that was my first exposure to the South/Midwest. It's Midwest, but that kind of, the kind of population base, kind of similar. And also then I went all the way to Baltimore for psych. And then in my internal medicine residency was in New Jersey. And then I applied for fellowship in Pittsburgh, Missouri. In Pittsburgh, Pennsylvania. So I went to Allegheny General Hospital. That's my fellowship program. My internal medicine in New Jersey was at Overlook Hospital, which is part of the Atlantic Health. So it's in Summit, New Jersey. So that's how everything all started. And of course, once you made that decision, to do, medicine, so the rest is easy. You just decide what pathway you want to take. You like procedures. I kind of like procedures a little bit, but not too much. I don't want to stay hours doing surgeries, right? But I do enjoy shorter surgeries and procedures, chest tube, bronchoscopy, central lines. So that's how it came about. And then, then because I'm from Canada, right? So I'm on a visa. So I have to go to an underserved area, which is actually a very, an interest of mine. Normally I love the underserved area based on the fact that I've experienced lack of healthcare or insufficient accessibility, right? In Nigeria and even part of the Netherlands Antilles, right? They have to fly people over to places, to get the adequate care, right? So, I came to Fort Smith, Arkansas, because that's a very common question. People ask me, man, how in the world did you arrive there? But so then, so that's where I've been. It's my first job outside of fellowship, and I've been here for the past 5 years, and I'm actually in the process of transitioning to private practice now. I'm starting my own practice and leaving the corporate medicine, but that's a different question for another day. But that's where it is. And then, the financial freedom obviously allowed me to do that, right? So to be able to say, fine, I just want to do this now, choices. So that's my medical journey. I know it's a lot, but I try to be as
hopscotching across the United States is very interesting. And talk about culture and diversity. I mean, you've seen it all from where you started, right? Nigeria to Canada. Not too much crazier than the United States. But then inside of the United States, several jumps across there. And the first thing that pops into my mind is, how did you do your living situation when you're always moving like that? Were you always renting through that time period?
Yes. And funny enough, the school actually did a good job of always kind of setting up some form of housing arrangement for you. But you're right, though. And that's, I used to run a blog, and I used to tell people, you can survive on 2 suitcases. Mm-hmm. People don't believe it.
Yeah.
But throughout all of this journey, I lived on just 2 luggages because that's how much I can carry through the airport, right? I checked in, right? And I have my little bag with it, and that's it. So yes, so when you are living in a minimalist lifestyle, you literally, your options are, endless in terms of, you could scout with someone temporarily, right? Mm-hmm. I have to do that sometimes, with another student that is rotating in that area temporarily until I find something. And then usually you find someone that need a roommate, you share the rent. So, Yeah, it's actually quite easier than than people think,
Yeah.
as long as you don't have a lot, and you're not very demanding person.
That's an interesting plan, especially today. Like there's this kind of nomadic lifestyle that's available now where it's traveling where you're not tied down. A colleague of mine was actually doing that. And when I was traveling with him different places, he would stay in Airbnb. So maybe go to this place, South America for a month and then over in Europe for another month in this place and then back in the States somewhere. So would do the same thing, would live out of a suitcase. And the idea of two suitcases, the real challenge comes transporting books, Bayo, when you're traveling like that, because books are heavy, man. And when you're rolling through the library, when you're rolling through the airport and you've got one suitcase of books, if you wanted to travel with books, it creates a challenge, but it also creates an opportunity. Man, what a way to live and share. In this blog, it sounds like that you've shared a lot of that with other med students, kind of going through that same process, right?
Yes, yeah, we had the blog Dr. BDZ Finance,
Mhm.
not to be confused with Dr. BDZ Capital, but so the blog is the finance blog. And then, yeah, I wrote multiple things about, how to be a minimalist. Of course, now that I have like three children, a wife, you
Mhm.
know, the minimalist lifestyle is difficult to
Kids,
maintain, but it's
yeah.
what I really deep down in my heart believes in, just
Yep.
few things, you don't, not materialistic. So you're right. So it's, it's something that, I share. Yeah, I did share with people. And I think people should, consider it, at least
Yeah.
decrease.
It's a great, in order to make the transition from I guess broke to wealthy. I don't know other way of putting that, of living that kind of lifestyle where allowing your you're not allowing your expenses to creep as your income increases. So when you go from residency into attending, like there's a shift in your income, and you don't want that shift in expense to do that as well too. So maintaining that similar kind of lifestyle. Not everybody can be that I guess self-discipline when it comes to it, but the idea of it staying minimalistic is huge. And Bayo, you said that that what was the name of that blog that you had written?
Oh, Dr. Breathe Easy Finance. Same thing
Finals,
is
Finals.
no finance.
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 Yeah, yeah,
Yeah.
finance. Dr.
Yeah.
Breathe Easy Finance. Very cool. All right. And so we're going kind of shifting from place to place, being very I guess not tied down is a good word for it, but that gives you the ability to move what you needed to where you needed to go. And you're in Arkansas now, Fort Smith. And where does real estate come in? Like where was the first time that you saw real estate or an opportunity in real estate?
Funny enough, when I was in Canada, even during my undergrad, we already started the real estate a little bit, but I don't consider, I don't even list it as part of my experience. But we do what is called reassignment homes, right? And I kind of do it with my parents. And so when there's a property that needs to be a builder is trying to build let's say $500,000 for each unit in that area, right? In Toronto, things are expensive, and so you put 10% down, but between the time that you put the money down and the time that is you complete the building, they complete the building, you could reassign it to anybody else that you like. So that's provided a very big opportunity for us. Of course, we didn't have a lot of money. So we started small, like 25K, 50K, or use other people. And I was not even aware that that's syndication at the time. I would just call like few people, like, my parents, and like, you have friends, and you have five of them with 10,000, and then we put 50,000. And then oftentimes we triple our money, right? Because if you sell it, you reassign it somebody in a year, and you reassign it for 650. So that's 150 extra. And after the tax and everything, you still double your money. So it was good. And Canada, Toronto was in the bubble for a long, long time. I think the bubble just burst in terms of real estate. They were really doing great from 2019 or 20 all the way till now. So, so anyway, so that's the first start. But then, of course, I went to medical school. I kind of was doing Forex trading, on the stocks and day trading. I've always been kind of entrepreneurial in my mind, always trying to do something else on the side, trying to make extra money, do some surveys. And then finally, when I finally have good enough money, my first 8 units was bought in late 2018 slash early 2019. So I bought an 8 unit complex with my own money. Because before in fellowship, I was moonlighting and I was doing the limited partner deals, right? So I would moonlight, make $25,000, put it into some deal, right? As a limited partner. But then immediately I finished fellowship, I got my sign-on bonus and, and I was like, you know what? I want to try to be a landlord, try to be an operator and see what happens. And, you know, um, I did not let analysis paralysis happen to me, or maybe I was too bold, to be honest, but it turns out to be a good time. So I did just whatever due diligence I knew at the time, I bought it. And since that time, we've been acquiring. And then eventually my friends, right, after they saw that, I was able to refinance in 2 years, return my money and my friends' money, So, and then people have started to ask me, can I do it with you? So then I kind of started doing the same thing, that I was doing in Canada during my undergrad to be like, okay, fine, you have 20K, you have 20K, with no formal structure. But eventually, obviously, I was educating myself. I got a mentor and I finally, started like Dr. BDZ Capital. So then I formalized everything. So I'm going to say we've been around since 2018, I'll say, and, but heavily in the past couple of years.
Yeah,
So right now we have 143 million under management. And I always say this, I know I have 62 units of my own also. So even as I do syndication, even though we have 883 units, but I also have 62 units of my own. So I kind of enjoy it. I enjoy just the whole challenge of it, and also try to help other physicians achieve financial freedom.
Yeah. And I think that path of financial freedom, these compounding returns of where you said it, you got your signing bonus after leaving fellowship, right?
Yeah.
And then you just took that money and boom, you put it right into real estate, and then just compounding those returns. So when you take those returns and say you made 25 or whatever from that deal, you go and you put it into another deal, those funds into another deal. So that's that compounding effect of your returns. I'm looking at your portfolio here on Dr. Breathe Easy Capital, and couple of things jumped out to me, Bayo. Actually three things. So one is oil and gas is on there, and on the page separate of that, I noticed that, or right in front too, a W-2 income write-off for oil and gas investments. That's very interesting. So it's no longer a passive versus active scenario. You can directly, neither one of us are CPAs. Obviously, this is not tax advice, but it's likely that people can write off depreciation from the oil and gas losses, basically depreciations, right onto their active income, huh?
Yes. Yeah. So, yeah, the problem so actually we all kind of follow the same trajectory, right? Physicians, right? So your first problem in life was you have loans and you have low income or none. So your first goal in your life is like, I'm going to increase my income. And you figured, in my mind, I was like, man, if I can make $500,000, man, all my problem is going to be solved. Like, I think that is it for me. Like, the peak of the peak. Nobody can say anything to me, I feel like I'm using my self-actualization. And then I reach it, I'm not going to lie to you that, most of it is just real estate. Of course, I have high income, right? And then being in the South as a pulmonologist and critical care doctor, you do get paid a lot to stay here, right?
Mm-hmm.
But I put all of that into investing, and I have a wife that is very cooperative, we rented for a while to get that done. So, but, yeah. So what I'm just saying is, so then the next focus then after that is you find out that half of it is gone to taxes. And then I have two choices. I'm already working 80 hours a week, right? As a critical care doctor. So instead I had more hours, which is going to impact my lifestyle, my other businesses, and my family. Then the next step is it's easier to save 100K in taxes than to work extra hours to make $100,000 more. And out of that 100,000, you're still going to tax half. So you have to make 200,000 more. So that's why I started looking for that. And then that's how we came across oil and gas. Mm-hmm. So because I do have real estate professionals, and I know this is not the major, it's a topic of discussion for today, but my wife stays at home. So we're able to actually use my depreciation against my W-2 income, right? So, but many of my investors does not have the same opportunity, right? Some of them are double physicians.
Usually married to doctors.
Yeah, double physician income, which is good. It's powerhouse, right?
Yeah.
It's power couple.
Yeah.
But then now they have more taxes. So that's why they started doing W-2. And last year, I think for 100K invested, we got like $90,000 back, right? Of just like depreciation.
Yep.
I used against W-2 immediately. So for me, that's already $30,000 or $35,000, depending on how you look at it, right? That I automatically saved.
Keep.
And that's not on top of the return.
Yes. Yeah. The real money that you keep instead of pay out. Keeping the money that you make is so important. And I love how you just put that together. So physicians following the same path, all struggling with high debt and no income, little to no income at first. And then when you do flip that, you get your debt paid off. You have this high income. All of a sudden you've got high taxes. Yeah. Right. So finding that way to work smart, not changing your lifestyle necessarily because you're already working as many hours as you can. Yeah. You're going to keep more of the money you make by investing wisely. That's awesome. And you did mention there briefly the real estate professional status, which is amazing when you have a partner who does have the ability to show the credentials or the correct material involvement, material participation, stipulations on the investments. So that's awesome. Second thing I saw on our properties is a beautiful, big, multifamily. And I love it. I drive by these things all the time. And, I first started driving by them. I would tell my son and my daughter, I said, what's that? What's that? And they're like, house, apartment. I'm like, no, that's cash flow. That's cash flow right there.
Yeah,
I love those things, man. And this big, beautiful multifamily that's on there, I noticed that looks like it's phased out in new construction. So that's an awesome path too, to new construction multifamily. This thing looks like it's, I don't know, maybe over 100 units,
Yeah, are you probably looking at the one in Northwest Arkansas? Mm-hmm. Watercolor? Is that the one?
Probably. I'm just looking at the front page. I don't have it broken out.
So I think that was one. Is a 376 units. So
376.
It's actually a mixed deal in terms of there's a builder that was constructing this and already finished close to 200 units already.
Wow.
Already rented about 95, 96%, right? And then he was trying to operate those 200 at the same time trying to build the last, 170 something unit, right? So he was having trouble with his operations. And so, it's a group of people, it's not just us that took this deal down. There's about 7 operators because it was a $21 million raise, $21 million, so, and it was $79 million, I think, for acquisition. So it's a big one, right? So, yeah, so, and then everybody got together and then we struck a deal with the builder and said, look, operations is different from construction, right? So you got yourself an operation problem. So you can continue to build this. We're going to buy it and kept him as the team. So And then that's how everything was done. So, we
That's
closed on
awesome.
phase one, and then we closed on phase two after I finished constructing. And then we closed on in June for the last one, and investors already got distribution last quarter.
Wow.
So, um, so it's because of the cash flow from the first two, right?
Yeah.
So it's a good balance. But yes, you're right about construction though. We'll try to get into actual full construction, but the only problem with that is we're very cash flow focused, and usually you don't get paid for about 2 years, right? Until the construction is finished, right? You don't get any distribution. We do have two new construction that we did, which is luxury senior living. So we did a luxury senior living, and one of them just got completed this June. The other one, hopefully by the end of the year. But people have been invested in it for over 18 months now, right? Waiting for returns. We do know that it's going to get higher return because we locked in low interest rate, right? A couple of years ago.
Nice.
And also the materials were cheaper.
Yes.
So we think we're going to do well. But the problem is still in the air, right? So everything has its own. You're more likely to double your money, high equity, more equity multiple with construction, but your cash flow is low, right? So you just have to decide which one you're looking for. But most of our
It's
people
like
want,
all that's like all real estate.
yeah.
Yeah, for sure. Um, so this path, when you say you locked in on a low rate, what is a typical? I know every deal is going to be different, every loan product is going to be different, but for you, like what's the typical length of a locked in rate look like for the multifamily deals that you're in?
5 years usually. We find out 3 to 5 years is usually what our plan is overall. And, we do believe that 5 years allow you to go through multiple cycle of the market. And, you don't have to sell after that 5 years. You can always reassess. You can cash out refinance. One way or the other, we always exit within 3 to 5 years. Maybe not completely exit. There are some that we just cash out refinance, give investors back their money. And then if everybody agree, to be like, look, now this thing is cash flowing like 12%. Let's just get this 12% until a good opportunity to sell comes,
Mm-hmm.
and we kind of just get a gauge based on the investors. So like, what everybody's looking for. And if most people, agree, you just keep it.
And then on that refinance loan, what kind of term lengthwise would you look like on that refinance loan?
Oftentimes when you refinance, you can get agency debt now. Usually because it's very stabilized, it's usually called DSCR loan. And you can refinance to like 30 years at this.
Wow.
You can refinance to a longer term because it's a very stable asset at this point. So the the most risky time is the beginning, because
Mm-hmm.
at that time you're buying at maybe a lower cap rate, and maybe there's some occupancy issues, some renovations to be done, a lot of uncertainties. So you bought a property for the past, out of the 5 years, you spend the first 2 years renovating all of the units, right? It looks good now. You've increased the rent. Everything's going smoothly by 5 years. So at that time, it's just about getting people back in, innovating a little bit when people move out. So it's really, the operation challenge is not that much anymore. So when you do go to the bank during that time, they give a very good rate,
Yeah.
and good terms. Yeah.
And then the other thing that jumped out to me on the portfolio page is Anchorage, Alaska. How in the world do you go from Arkansas and Oklahoma and Texas to Anchorage, Alaska?
So, the Anchorage, Alaska is actually, so we do have a I'm part of a mastermind group. And also I do some mentorship, right? I mentor people. So what I do sometimes is have some of my mentee, do their first deal.
Mm-hmm.
So, and, if they live in Alaska, right, and they find a good deal there, and I've been with them for like a year, I kind of trust them. So we could do that deal under our umbrella. It looked like it was a smaller deal, it was a 30 units or so, but so mostly it was one of our mastermind members that did it. And then, but usually with that, we kind of joint venture it together to kind of help with the process, the due diligence, and also basically bringing the deal to the finish line. So, and then I put my own money. I think I put like for $75,000 of my own money into it to encourage him, and another, so yeah. So that's how usually this one. So you can't do this alone. You need partners.
Yeah.
And there's no better partner than someone that you actually train yourself.
Yep.
So that's what I'll say. Like, for example, where are you? Where are you located?
Carolinas.
Carolinas,
just outside
right?
of Charlotte. Yep.
Charlotte, right? If you find a very good deals, we've been hanging out for like after a year, keep in contact, and you find a good deal there.
Yep.
And I know I have somebody that I can trust that's an operator there. There's nothing stopping us from doing a deal over there.
Right? Yeah. I hear you. The world of real estate, and I've heard this since I've heard it the first time. I find myself saying it a lot. Real estate is the business of relationships. And this, especially syndication, multifamily, to grow with like-minded people that have the same values, people that have the same drive. That's how this stuff happens. And that's exactly how you go from Fort Smith, Arkansas to Anchorage, Alaska, all in one breath, for sure, with the people that you trust and you share values with. That's huge. Yeah. What is the current multifamily market right now in regards to cost of money, in regards to insurance and taxes? Those big three things: cost of money, insurance, and taxes. What do you have to say today about this right now, Bayo?
Okay. Well, it's good that you asked that question, because we actually have issue. And adding to that problem is actually also like actually finding the deal itself. So it's the whole climate is much difficult right now. So let's say in the past, 3 to 5 years, which I'm including myself, any Jack, Dick, and Harry can run an effective real estate company, to be honest. I'm not going to lie. Because there are people that, I see the mistake they made, some mistake I made, 5 years ago, and everything turned out all right anyways, right? And that's because of the market was very good, right? So now it's when you know the good operator from the bad. So, and we've been very cautious. So number one, cost of money. So the cost of money, of course, is too high, right? So our last deal, was in April this year, right? 129 units in Fort Smith. And since that time, we've been sending letter of intent every single week, sometimes 3 a week, right? And since that time, think about it. Till now, we barely have one under LOI now, waiting for the final things, right? Think about in terms of multifamily, we do oil and gas in between, obviously. But so what messed up the deal? There's the 48 units I almost got in Tulsa. It is the cost of money that messed it up. I know it's a good deal, right? Literally, we know the price per unit is $75,000 there. We have property. I have a 33 units by personal one there. We have a property management there. And this is being offered at 54 per unit.
Wow.
Right? Which I know that, but when I put in interest rate of 8.5%, the whole deal fell apart. Despite the fact that it's much below. So I have to get it like maybe 48 per unit to make it work. And they will not sell it, right? Obviously. So the deal fell through. So the cost of money is high, like the interest rate is very high. You have to be very, very conservative in your underwriting at this point. Many people are, there's lots of operators that are failing right now because of the variable interest rate, right? They had variable interest rates a few years ago and they never locked it down. So they were running it at 3.5%. So now they're running it at 9%. So that kills your cash flow completely.
Yeah.
And the first thing they do is to first stop distribution, right? The next thing is to do a capital call, which means you ask your investors to bring more money to save the deal. And that means, and then ultimately everything fall apart anyways at the end. Or you sell it to private equity and you wipe out your limited partners. So the answer is cost of money is high. You need to be able to buy it at a very, very good discount rate. And your business plan need to be flawless. And that's why we stay local for most parts, like for most of our deals right now, you need to be where you can really keep an eye on it, or someone 100% you trust with your life, right? And then the insurance is another problem I'm having. So the insurance, I'm not, it's gone up a lot, and the insurance have not messed up a deal so far for me. It's gone up, but it's from the grand scheme of things, it does not make or break a deal. I would say the cost of money more likely to break the deal than that. But it has gone up though significantly. We had a deal in Florida, St. Pete, and part of the issue was the insurance. The cost of properties went up a lot, but insurance also went up a lot. And I think after the hurricane or natural disasters that happened over there, and they have to pay, insurance companies have to pay a lot of money to fix those properties and roofs and stuff. And I think they end up getting it, gouging it back from the investors over there, because some of them went up like 3 times.
Wow.
It makes no sense, especially if you even flooded area. It was not a flood zone, but because it flooded at one point, they still try to deduct so much points from you. Mm-hmm. Another one, then the taxes too. Taxes is also not make or break. The taxes has to do with the cost of the property, right? For us, I think it's 0.07, if I got it correctly, percent or so of the property. So we usually put that. Before, maybe it was 0.6, then it went up to 0.7. But regardless though, in terms of the percentage, it's still close to similar. But the problem was, if a property was in $1 million 2 years ago, you're buying it for $2 million now. Right? So now your property tax are just doubled, right? And if you're underwriting, because when they give you the profit and loss, they will put their own insurance and taxes on there, right? Their own. So you have to think carefully and make your own assumption properly and think, man, this tax is going to double now. So, so just make sure that you don't underestimate the taxes and insurance. But yes, cost of money, insurance and taxes, higher than I would like it to be. Yeah. But the one that really kills all the deal is the cost of money.
Yeah, big time. One of the challenges I have, Bayo, is even in the underwriting process that the market is so volatile with cost of money. I can get through underwriting and then the interest change so fast that even those incremental changes in the cost of money affect the deal so much, so drastically, that it's hard to make a turn when the cost of money is moving so fast.
Yes. And yeah, true. And we've lost a deal because of that before, late last year. Yeah. We locked in the interest rate at, I think, 4.5 or so. And, it took about 3 months, for other reasons to go through the due diligence, this paperwork, that paperwork. And when it was the last month, literally a few weeks to close, the bank told us, oh, we had our final meeting. And I thought that was locked down, right?
Yeah.
But apparently there was subject to some committee.
Yeah, committee approval. Man, yeah. I've lost them at the closing table. Like, I'm going to close, I'm going to sign, and boom, they yank it from you.
I know. So that happened actually. Yeah. And, it was a low point in Dr. BD's capital, history, because we actually already have all the money in the bank. In their bank, we have everything ready.
Yeah.
And all the investors already have their money. It's not like we don't have the money. We have the money already.
Yeah.
We just to close. That's it. But they said, oh, now we do you mind we increase it to 6.5%? I say I mind a lot.
Why?
I
I mean,
mean,
I
if
can't
we
do
go
it. That's what it means.
from
Yeah.
4.5 to 5,
Yeah.
that makes sense. Maybe we can work it out,
Yeah.
But anyway, we never could be able to work it out. We have to return all the investors' money back,
Yep.
because, there's no need to push a deal that's going to hurt investors and hurt
Yep.
our brand. So
Yep.
anyway, so
Absolutely.
yes, cost of capital is a big deal and it changes so fast.
Now, when you're underwriting, is there a go-to per unit, and you talk about buying for cash flow, like a per unit net number that you're looking to get per unit?
Not exactly. We look
Okay.
at it as a whole, because we use what is called a Michael Blank's underwriting tool. So if you use, like a robust underwriting, we start with sometimes with bigger pockets one to do a quick
Mhm.
one, and then we'll go to the underwriting model that we use. And
Mhm.
oftentimes we have our minimum. First, I tell them, do not send me any deal that does not double investors' money in 5 years. So they already know that, right? So, and then I want cash on cash return of, at least 8%, right? Because if you can't get 8% without the LPGP split, there's no way you can get a good one, right? After you do the splits and, acquisition fees and everything. So I make sure of that. So based on that alone, the deals that I get is already decent deals. And then I have my acquisition manager, who is a commercial broker, so he's the one, part of the team also. So he does the initial underwriting and then send it to me. So for me, what I'm looking at now is looking at if the assumptions are correct. And if the assumption is correct and I see my, 6 to 8, after the split and everything looks good. So that's what we look at. We look more of the cash on cash, IRR, and also the average annual return. We look at DSCR too to make sure that it's as close to 1.2 as possible, or at least after we finish the renovation and increase the rent, that it's much higher, right? Because we're looking at refinancing, right, in 2 to 3 years.
Mhm.
If if the interest rate goes down, because
Yeah.
right now it's actually difficult to refinance, right? Because there's a deal now we could, right now we're ready. But if you refinance from a 5 to 9%, you're going to be negative cash flow. So
Yeah. And when you say double investor cash in 5 years, that's triggered by the refinance, correct?
it could buy sell anyway.
Okay.
Yeah.
Okay.
So whatever it is, any way that you want to exit.
The
So
performa has to
often,
project that, whether it's sell or refi, for the investors to double the cash in 5 years.
yes, that's minimum. We try to aim for higher, but I feel like any investment, that you cannot double your money in 5 years is a weak investment overall, right?
Mhm.
Of course, you may not hit that. You might hit 18% instead of the 20%, right? But if you have your target good, right?
Mhm.
Then but if you're looking for a deal at 15%, then you might get 10%.
Right. Right.
So yeah,
Interesting. Lots of stuff here, man. I could go on for hours and hours talking about this.
I know.
The one thing that we did mention, we kind of brushed over a little bit. The LOI, the letter of intent, is basically like an offer for a commercial property, right? It's this letter, basically of interest that you'll put out and say, "Hey, I want to buy your property." What happens is they would sign that, right? And that's kind of like the beginning process
Yeah.
of the commercial process here. So I have this, I said it before, drbreatheeasy.com. It's DRBREATHEESY.com. That all this information I've been looking at is on there. And you said there's an ebook coming very, very soon to drop some more of this knowledge that's out there as well too. Is there any other way or anything else that you wanted to tell the listeners about, man, what they should be doing?
Yeah.
What they could be doing, maybe not what they should be doing, but what they could be doing.
So I mean, right now we have an investment group. Mostly we run it through the WhatsApp group right now, and we just, it's free to just join that, and post content, and people can have access to ask questions anytime. So, so they can join that by just going through on the website. join the investment group. You can click it, put your email, you join our email list. And oftentimes I do a one-on-one call and I ask if you want to be on the WhatsApp group and I add you there. That's one thing. And we do have a mentorship tutoring program, even though we don't put it anywhere, but we do, if they really want to, do, limited partners, like you want to learn everything you need to know about being a limited partner, or if you want to be an operator like me, which an operator is just not just raising capital, finding the deal, analyzing the deal, doing due diligence. You want to go through the whole process and actually run, you just have to understand that it's a full-time job, sort of. So I have two full-time job-ish. So, and you have to have a team. You have to have an acquisition manager, business analyst, virtual assistants, and then we can, direct in the right direction. And also, we do a webinar every 2 weeks. So that also gets you into the webinar every 2 weeks, and we educate people on different asset classes. So sometimes, and we have a YouTube. If you find Dr. BDC Capital, you can find our YouTube. So which basically you can look at how to find a deal, ATM deals, what does it look like, how to raise capital, mindset, how to change your mindset.
Big piece.
So those are the things, And if I were going to leave with one thing else is Tax-Free Wealth, right, by Tom Wheelwright. It's a book that I would say everybody needs to read. It's changed my life in terms of knowing fully well that I can pay zero taxes if everything is done properly.
Tax-Free Wealth is the name of the book?
Yes, Tax-Free Wealth, yes.
Tax-Free Wealth.
Yeah.
Very cool.
It's like, good. You'll be surprised. I mean, I thought I was like, you know what? This is overselling it. But when I read the book, I'm like, it's possible. And we are doing it now. I have literally over $1.6 million in depreciation last year. And I couldn't finish it, right? I cannot finish using it. My accountant said you can only use 540,000 of this.
Oh, wow.
So, which means I have $1.1 million of depreciation to use again for this year, which I already did another deal this year. So it's going to just continue to go and compile on each other for like a long period of time. I don't know when I'm going to finish it. So this is just things that are possible by doing, after reading the book and of course, mentorship and everything. And another one is Traction.
Oh, yeah.
Traction.
Gino Wickman.
Love it.
Yeah,
I love it. It's like literally, I was running my organization almost, I don't even know, like a hobby until I read Traction. I'll just do like, okay, you want to do something? I write it down, you don't really have a vision, no tracking, nothing, just kind of just in the wind.
Yeah.
But after reading that, I'm like, man, and I have a lot of work to do.
Yeah, absolutely.
Are the two things I'll say.
Yeah, Traction, Gino Wickman, great book. Even another, almost a multiplier on that is a book called Good to Great. And Good to Great, yeah. And then Good to Great. Good to Great.
Oh, to Great, okay.
Good to Great, yep. And another one to add on to that too is called Scaling Up. I think that was very interesting. So like using Traction as that foundation and then using these others almost as amplifiers.
Wow. I can't even believe there's something else above Traction. Yeah. Man, I have a lot of work to do.
It's an add-on. It's an add-on. I think Traction is like this, is the nucleus, right? Is the center of it. And these other things are like add-ons to it. Just, it's a mindset piece and just kind of like opening up even more,
Oh, perfect. Thank you for that. I mean, I definitely have something to read for the next 1 month now.
There you go. There you go. Awesome. Well, hey, man, thank you for your time today, Bayo. It's been absolutely wonderful. We'll stay in touch for sure. Have the listeners reach out to you, stay in touch with you as well, because relationship is the business of, real estate is the business of relationship. And right now it's extremely important because we went through this. The difficult cost of money, insurance, and taxes have created a crunch in the opportunities. But through relationships, we can increase our opportunities. That's the biggest piece. So staying in touch, going to drbreatheeasy.com, getting on the WhatsApp group, staying in touch and reaching out to everybody, the listeners out there, reaching out to the people that because we build relationships, we increase opportunity. And if there's a way now that we can't control everything else. The one thing we can control is expanding our association and reaching out and building those relationships in order to increase our opportunities. How about that?
That was good, man. And you said it in one take. Perfect.
Yeah, yeah. Perfect stuff, man. But that's awesome. Thank you for your time again, Bayo. Absolutely grateful for your time, sir.
Okay, thank you, Brett. Thanks for having me. I really appreciate it. It was such an enjoyable moment for me.
It
Thank you.
it was awesome, man. And to the listeners out there, again, as always, thank you for your time and your attention. I'm feeling more and more physicians coming together, and I can't express this enough that the relationship building is massive. And as we've learned today, I feel like that's how we can take back control of the minimal opportunities out there. Is the more relationships that we build, the more meaningful relationships that we build, meaning that our values align, our character aligns, these pieces, our drive aligns, our integrity aligns. Those are relationships that we need to build in order to increase the opportunities that are available for us. So thank you again for your time. And until the next time we see each other on Real Estate Mogul MD.